Welcome. It's the Southern Fried Finance Podcast, where your hosts, Vic and Mike, will cover a host of topics related to small business taxes. They'll also touch on an occasional baseball topic, some college football talk in season, and maybe some out. And obviously, we'll talk about the best fishing spots and our best barbecue joints we've found lately. But it's a tax issue, y'all. So sit back, grab something to drink, and get comfortable, and join us for the Southern Fried Finance Podcast. And here's your hosts, Vic and Mike.
Well, good morning. Hey, everybody. It's Mike and Vic here with another episode of the Southern Fried Finance Podcast. Today, we're going to talk about our favorite tax deductions. And so just to introduce this again, in case you hadn't watched one of these, I'm Mike Ferris. I've got a little CPA firm in Longmont, Colorado. We work with a lot of small business owners and self-employed people. These deductions we're going to talk about are prevalent in all of these returns we're working on. My firm's been around now for about 10 years here in town, and I've been practicing though for a little over 30. So we've been working with this stuff for quite a while here. My buddy Vic here is going to talk about it with me. How you doing, Vic?
Thanks, Mike. This is Victor Rouse. I'm partner in CPA firm with my mom in Eden, North Carolina, and Dad founded our practice in 1965. I've been working in it since 98 and practicing for over 30 years, and work with a lot of small business owners and individuals. And my practice is a tax practice with some S corps and partnerships and estates and trust and a little bit of large company stuff still. So it's pretty diverse tax practice. But we're busy and kind of excited to do these podcasts. This one today is going to be fun. We're going to talk about tax benefits that our clients enjoy taking advantage of, and that Mike and I both take advantage of a bunch of these as well. So these are things that we know an awful lot about. So anyway, Mike, you want to get started? I think we're going to start by talking about tax deductions that we get for paying ourselves.
Yeah. You start thinking about, well, how do deductions work? And you get deductions for a variety of things. And one of the best kind to me is the deduction I get for paying myself. And those are things like putting money in an IRA or a 401k or a SEP account. You know, you're putting money out of one pocket into another pocket. It's still your money. Now, there may be some strings attached to it, perhaps based on how old you are or different factors, but it's still your money and it gets to earn income that you probably don't have to pay tax on currently. And these are nice little things. So if I can find a way to execute a personal saving strategy of some sort and take a current year tax deduction for it, in a lot of cases, that's something that we like to do.
Yeah, retirement planning, 401ks and SEPs and simples and all the different types of retirement plans where we get a deduction for when we're working and we're putting money in there, and we get to ride this tax deferral train all the way to when we get to retirement and we take distributions. I mean, the bottom line is it just makes millionaires out of ordinary people with ordinary earnings. It just makes them millionaires over a long period of time. And it's not the vehicle that does it. It's the process, the discipline involved in saying, okay, I'm going to go take this deduction. I'm not going to spend this money now. I don't need to spend it now. I'm going to save it and invest it. And thankfully, over a long period of time, U.S. stock market and the U.S. economy has done pretty well. It's been a pretty great place to be.
And year to year, you might be caught, but over a 25, 35 year horizon, people's entire working careers, that's generally long enough to make it work for you. Yeah.
Yeah. And I think one thing that I like to point out to people is your time horizon may be longer than what you think. So if you talk to somebody that's, my age or some a little older, and they think, okay, I'm going to retire here sometime in the near future. Well, do I need all this money in these equity markets in my 401k? And well, you're not going to spend it all the day that you retire, probably. I mean,
Right.
you might, but I don't think you're going to do that. You're probably not going to do that. You're probably going to live a long time unless, something's wrong with you. And for a lot of our clients, if they're thinking that, they're not even going to spend all their money, they're going to, leave it to children or grandchildren or charities or whatever, somebody else is going to spend it. Well, then, it's going to grow for a really long time.
Right.
And so you get that tax deduction in the current year. We're going to save a little bit of tax money now, or maybe a lot of tax money, depending on what we're doing.
Depending, yeah.
But the real benefit is in this deferral. I've got this money in this place that's growing, and we're not paying tax on what it earns every year. If I can leave it in there a long time,
Yeah.
there's a great benefit there.
And there's always a strategy to kind of balance the current year deduction versus the tax in the retirement years. And maybe a Roth makes more sense for some people where we don't deduct it today. That's another podcast session. But the point is, if we can set money aside and take a tax deduction and it's still my money, I didn't have to give it to somebody else. That's pretty cool.
It is very cool.
We touched on something the other day that you said, and I want you to kind of go through it here with folks. The HSA account, health savings accounts, you said they have a triple tax benefit.
Yeah, they do, and HSA. So let me just back up a little bit, because I think most people understand how their 401k works. We don't pay tax when it goes in. I don't pay tax when it grows, but I pay tax when I take it out.
Yeah.
Roth IRA, I don't get a deduction when I put it in, but I don't pay taxes as it grows, and then I don't pay when it comes out.
Right. Forever tax free.
So, but HSA, it's a triple benefit. So I get a deduction. If you have a health savings account, you got to have a high deductible plan. You got to have health insurance that allows for it. But I get a tax deduction for what I put in the health savings account. And if you accumulate some money in there, you can actually invest it. And I don't pay any tax as it grows. And then if I take it out to pay qualified medical expenses, I don't pay any tax when I take it out either. So I get tax benefit three ways with these things. So I do have a number of clients. It is very neat, but I do have a number of clients, and their strategy is to try to accumulate some funds in these health savings accounts. A lot of people use them, and I would say almost all the people use them. They make a contribution to the health savings account. They take it out about as fast as they put it in, because they've got, medical expenses.
We're funding out of pocket expenses year to year. Yeah.
And that's okay. But we do have some clients that are trying to build some savings in there and have some assets in there that they've got invested, with the idea that they're trying to accumulate $100,000 in their health savings account before they wind up, retiring, or they've got some money that they can fund premiums with, and increase healthcare expenses as they get older. And that makes some sense.
That's a nice strategy.
It is a nice strategy, and it can help create some additional wealth that can help take care of your family as you get older and you have some more medical expenses.
And in the real world, most of us are gonna have some kind of healthcare costs that we got to fund out of pocket as we get older. And we've all got eyes and teeth, and health insurance doesn't cover eyes and teeth. So I've been at the dentist this week, so
I have too.
That's right. Right. So
yeah, we've got eyes and teeth, and our eyes and teeth are getting older.
And they get older and they break down on us. So, healthcare is a real issue. And on the HSA accounts too, if for some reason you don't need that money for healthcare, when you get to retirement age, you can tap into it as if it were an IRA. So it's got a lot of flexibility associated with it.
I think my clients are using their health savings accounts more. It's taken a little bit of time. It's taken more time for people to get used to using them than I think it was thought when they were first introduced, probably over 20 years ago.
It's been a while. Yeah.
It's been a long time. But I think as healthcare costs and premiums have gone up, I think people are understanding this health savings account is maybe an effective way to lower my premiums by getting a
Mhm.
higher deductible plan. I think the economics of it make a little bit of
Yeah,
sense
you can,
for most
yeah, the
people.
math on how the premiums work with the high deductibles, and then you can save money to help fund some of that out of pocket. It's a nice little feature. Another one that I wanted to touch on here, and you reminded me of this too, was a lot of states allow a deduction for people that fund their children or their grandchildren's education costs in these education savings accounts, 529 plans. And you can fund up to the gift tax limit into an education savings plan and get a state tax deduction. Not as sexy as a federal tax deduction, but deductions are deductions, right? So,
Right. Well, I love 529 plans, and if you're working with clients, I work with a lot of clients that are trying to help pay for their children's ever increasing cost of higher education, and I I talk to them, and if you're going to try to help your kids, you have to start trying to help them when they're really little. Parents and grandparents, let's try to make some contributions to the 529 plans. North Carolina, we no longer have a state deduction for contributions to our 529 plan. We used to years ago. We don't have one anymore. The the plans still work. The
mhm.
plans still work. We have an excellent plan. The investment options are excellent. Um, my children all went to school on 529 distributions. We made contributions, and grandparents made contributions when they were little, and we did it every year. And you kind of think about, this kind of ties back into the whole retirement plan um, thing is, so my oldest daughter, Hannah, she was born in 98. So you think about what happened. We started contributing to her 529 plan back in 98. You had the dot com bubble, and everybody thought, oh, it's terrible. We had the Great Recession and the Great Real Estate Crisis, and oh, it's terrible. Well, she was born in 98. She's going to school in, the 20, I guess 2016, 17, 18 in that time frame.
Yeah.
And that's when we were taking these distributions from the 529 plan. When we were taking distributions to pay our tuition and fees, we were basically getting $2 out of there for every dollar that was put in. And so, that whole market up and down over a 20-year period of time really
It
helped.
ended up.
It ended up, and we were taking the distributions to pay those things. But the cost is so high. If you're going to help them, you got to try to start helping them, in the beginning.
It's a
And
nice strategy to use to
it,
let the markets help pay for some of that cost.
yeah, and
So
um, and
I've got
and
a
and
client we're doing planning, and they didn't have the money tucked away 20 years ago, but they've got the money now to fund it. And so the strategy they're employing is we just put the gift limit in the 529 plan, and then they withdraw it to pay tuition in a couple of months.
yeah,
So we get a state deduction though. We don't get any
yeah,
market help, but we get a state deduction.
right.
So that's a little bit of help.
Well, it's a
Take
risk-free thing.
advantage of what you've got, right?
Yeah, and in that case, that's a risk-free return on your investment. You're going to pay those tuition. You're going to pay it. You're cycling it through your plan, and you're just
we,
saving a little
we get a
state tax.
4.25% return out of the gate just because of the
Yeah,
deduction. So
yeah,
So,
and
it's little bits on the increments, but those little bits add up. That's kind of the ones I wanted to touch on for the paying yourself. What else do you got there? Anything that's worth
well, I
mentioning?
think we touched on Roth, and this is not, there's no deduction there, but we touched on the use of Roth IRAs. And I think really what we're talking about is trying to use the tax code to accomplish goals around in our life that are non-tax related. And we're just trying to find the most tax efficient way to do it, right? You're
That's a
trying to
great way to
fund your
put it.
we're trying to fund our retirement. We're trying to save for kids to go to school. We're trying to save to take care of our medical expenses. We're trying to do all these things. Well, we're doing those things for non-tax reasons, but then we're going to try to find the most tax efficient way to do it.
But they've
um
got a tax consequence, and let's
yeah,
be
so
mindful of that and try to use it to our advantage. Yeah.
so Roth IRAs, there's no tax deduction putting it in, but there's these great savings vehicles. Well, there's things to do with Roths. If your income is low enough and you've got earned income and you can make a contribution, it's a great idea, whether you're old or young. whether you're old or young. I mean, my children making Roth IRA contributions with earned income as they're in school going along, that's income.
That's a nice strategy.
And over a period of time, over their lifetimes, hopefully the accounts will grow. And
It gets back to a word you've used earlier, the word discipline. If you can get
yeah,
that 16, 17-year-old kid to put a few $1,000 of their part-time job money, their summer job money into a Roth account instead of concert tickets, that's a good strategy, and that creates discipline.
yeah, I have a great story about a grandfather of one of my clients, and um, he matched his granddaughter's babysitting income. She said, "Okay, I'll match it, and we'll make a Roth IRA contribution." So, she was motivated. She got a gift from granddad to put money in a Roth each year as she was going along, and she put the babysitting income on her income tax return. She paid self-employment tax on it. It's on Schedule C, all that sort of thing. Put money in the Roth. Put money in the Roth. When that child was 25 years old, there was a couple $100,000 in that Roth IRA. I mean,
That's real.
that's real. That's a life changing sort of thing. And obviously everybody didn't have the means to do that sort of thing. And
Yeah,
um,
but
but she had to make it. She had to earn it, right? She had to earn it to
and then she had
to
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 leave
make
it
that
in that
happen.
account
Yeah,
and
and so you
not
had to
go
leave it
tap
in
it
there.
to buy a car or to do whatever come up. Things come up and people make bad decisions sometimes.
And I think there's a lesson that's learned in there from the kid about, hey, look, this is what saving and investing can do if I can exercise this discipline over my lifetime,
Yeah,
I can make things a little easier for my family. And and hopefully they'll pass that on to another generation of folks too. So anyway, I thought that was pretty cool.
that is
Um,
nice. That's a
pretty
nice real
cool
world
pretty cool.
example.
Yeah, and then with Ross, there's just all sorts of things with Ross. If your income's too high, then maybe is there a way to do a back door?
Yep.
Are there people that need to convert some regular IRAs to Roth? We do that kind of planning with folks, and whether that makes sense or not. But use of these retirement accounts, use of these special savings accounts, I think is an important thing.
I agree. I agree. So, next category, my next favorite category of deductions is if we get a deduction for money that we were going to spend anyway. No, the retirement plans, you might think that's but those are discretionary. You can choose to put money in a retirement plan or not. But if I'm going to spend money for my mortgage and my property taxes and things that we are gonna or repairs on the house that we have to do, in some cases, some of these things can be deductible, and it's an opportunity to maximize the tax code to your benefit when the circumstances allow. I'm thinking kind of like the home office deduction is one of my favorites because if you're self-employed and you probably have a desk at home that you use, that likely, not in every case, but it likely creates an opportunity to get some tax benefits out of not just your mortgage interest and your property taxes, but your utility costs and repairs on the new roof that you had to do from the hailstorm. We have a lot of hail in this part of the country.
We had some of that last year too. I think home offices, we all like it, but the big benefit out of it for most people is if you've got a home office deduction, then then we're saying your home is your principal place of business. In order to be qualified for it, we can't have a office we're also going to, or that. But if it's our principal place of business is the home office, then what does that mean on your business mileage? That means I've got business mileage when I leave the driveway on a business trip, right? So,
Yeah, that's the real good avenue
yeah,
of
and
it because
so
if that is really the only place you work, then you get some extra little pops too. Yeah.
yeah, I think it enhances, it makes the deductions on the business mileage and the auto use, it enhances those. But again, these are deductions. I mean, you're going to maintain your home, right? I mean,
Right.
you're gonna make
Right.
that mortgage payment or make that rent payment. You're gonna do that. Um, you're going to do the business travel that you need to do. But if you claim the home office, we're claiming that's our principal place of business. That there's some benefits there, for sure, and it's benefit. I mean, you get it. You're going to have to pay for those things anyway.
That's the key. We're writing those checks whether we got the business or not. And we just because we have the business, we get to take some of these benefits. So
Yeah, I think charitable contributions, for a lot of clients, we think about that being discretionary, but for a lot of our clients, it's not really their discretion, right? They're gonna pay that church pledge.
it's
They are
ingrained
compelled to
behavior,
do it.
yeah, that
They're
they're
gonna
going to
do
do.
it.
Yeah,
They're gonna pay that church pledge. They're gonna make that contribution to the University of North Carolina. They're gonna do those things because those are the things that they're just gonna do it.
that's how they live.
Um,
Yeah,
right. So, we're gonna. How do we get the best tax benefit out of those things? Um, Sometimes that might mean, okay, well, we talked about this in one of our previous podcasts about the charitable
bunching.
contribution deduction and bunching and that sort of thing. Does that mean I pay next year's church pledge? I just go ahead and fund it. Do I do it? Do I do my charitable contribution if I'm taking required minimum distributions from my IRAs because I'm of an age where I'm required to do that? Do I do a qualified charitable distribution? I think a lot of times the answer to that is yes, if that's what we're doing. Um, but being a little bit strategic about those things. I think I'm going to pay these things anyway. What's the most tax efficient way to do it? And I think sometimes we can create a little additional benefit for our clients that way.
Yeah, and that kind of gets into the notion of year-end tax planning is not necessarily this room full of lawyers with contracts and documents and spreadsheets on the wall and moving numbers around into different buckets and columns and make it look all fancy and complicated. A lot of times, year-end tax planning is really just as being as thoughtful as going, okay, where are my itemized deductions going to fall this year? Where are they going to fall next year? What can I move from year to year to be a standard deduction person one year and an itemized deduction the next year, maximizing just the incremental benefits there. That's not rocket science. That's just half hour thoughtful planning and
You're
discussion
right.
with a client. You know,
It's it's not rocket science at all, but you do need to have it is an interactive conversation.
you gotta
You
be
know, how
pause, think about it, talk about it,
yeah,
make some decisions,
how
be
are things going?
purposeful and disciplined.
Yeah, I mean, how are things going this year? How are they going next year? What are your plans for things? Do these things make sense? And what we try to do is we try to think about it over multiple years and not just, how do we make 2025 the pay the absolute least amount of tax in 2025 as opposed to, you know, is that really the goal or is the goal try to have to be as wealthy as we can be, right? I mean, that's
Yeah, yeah. What are we
and
trying to do?
accomplish the goals that we want to accomplish with those things, whether it's funding educations or funding charities or taking care of ourselves or, funding in retirement or whatever it is, just trying to be just a little bit strategic about these things. But there's some nice benefits in the code to kind of help us do that.
There sure is. There sure is. So, third category, deductions that we get just because. And there's a handful of these in the code. If you're a business owner, you get a section 199A deduction that's just mathematically you only pay tax on 80% of your business income. Every taxpayer gets a standard deduction. You don't have to spend a dime and you get a standard deduction. And most of us do spend money on personal expenses, and the standard deduction kind of allows for that. But these are just mathematical gifts of some sort in the tax code, right?
Well, they are, but I just love 199A so much. I mean, it's my personal favorite. Um, it's it's a deduction that the business owner gets if we have profits, right? And if we own a business, we're trying to make profits. That's
We're
part of
trying to make money, yeah.
like that's how it works. Um, and they just give it to us, and we get 20% of net business income. Um, it's subject to some limitations, of course. It came in with the Tax Cut and Jobs Act in 2017. Um, It's now been with us for 10 years and it's been extended. There was debate earlier this year about um, expanding it to 23% from 20, or and then potentially limiting its effectiveness for for some businesses. But anyway, all of that never happened. We went right back to where we were before.
Right back where we were. Yeah.
20% net business income. It does affect like the choice of entity planning that we did talked about in our earlier podcast.
Yeah.
It does affect that.
There's a lot of interplay with
There's a lot of
entity
interplay.
choice. Yeah.
So, like if you're an S corporation shareholder, you get it on your net business income after you pay your salary. So, you know, sometimes on businesses maybe that are lower income, we might be better off just to not make S elections
That's one
and
of the factors.
let them be taxed as a Schedule C and grit your teeth and fuss about the self-employment tax. But I get a little bit better at qualified business income deduction, and I've saved some administrative costs by not being in an
Right.
S corp. So it does affect that choice of entity. Those discussions that we have, but the net result of it is we get a deduction for making money, which is what we're supposed to be trying to do
That's the
anyway.
idea. Yeah.
So, um,
It's kind
you
of
know,
backwards thinking. We get a deduction if we made money.
yeah,
It's
yeah,
weird. Yeah. It's kind of like the
yeah.
tips exclusion.
Well, I think, and you and I have talked about this a number of times with business owners, and it gets this time of year, and they think they're looking for tax deductions, and Code Section 162 is an ordinary and necessary. Well, if it's ordinary and necessary, the production of income in your business, generally those things are deductible. And the advice that you and I are very consistent and together on this, and we tell people is like, okay, if it's necessary, yeah, then go ahead and spend the money before the end of the year. Cash. So we're talking about a cash basis taxpayer
Yeah.
making a deduction. If it's going to help you make money in the future, then let's go ahead and spend the
Then do it.
money. But don't just go buy some kind of new gadget that's so we can take a tax deduction.
Just
I mean,
take a deduction.
if it costs money, if it's going to take money out of my pocket, it's not going to make me money in the future. I mean, even if I get a tax benefit that's 35 cents on the dollar, well, you know, you
That
so it's
makes it
65% gone of the money's gone, right? I mean, still. Um, so I think just thinking about it, in terms of 199A, well, if we make the money, I get a little better 199A deduction. 199A is a permanent deduction. So this is only like
not a
exciting
deferral.
this is only exciting for kind of tax nerds. But Mike and I will talk about deductions in terms of permanent items or temporary items. Temporary is like depreciation. I get a deduction over a period of time. Now we have 100% bonus depreciation. We could buy a piece of equipment and write it off all at one time, but it's still temporary, right?
When you sell it, it comes all back home to roost. So
Yeah. But 199A, if I make the profit this year, I get that 20% of net business income. There's no recapture of it in the future. I got it.
yeah, you don't.
I got it. It's going in my pocket. It's permanent.
Yeah.
And
That's
that's
one of the
kind of
best ones in the tax code. I
It's
agree.
beautiful. It's
Yeah.
beautiful. If we were talking about a public company or something, it'd be something that would improve their or lower their effective rate, and that would make a CFO somewhere pretty happy about it. So, if you're an individual and you're a business owner and you're getting 199A, it means we did a few things right. We made a little money, and they're going to give us a tax deduction because of
That's
it.
right.
So,
The other one that is really a gift, and everybody's aware of it, but if you sell your personal residence and
mm,
then you don't have to pay tax on the full gain. And in a lot of parts of this country, people just don't pay tax on their personal residence because if you're married, you can have a gain of $500,000. If you're single, you can have a gain of $250,000 and walk away tax free from it. So that is a nice little gift for homeowners.
it really is, and this came in.
It allows people to retire and sell their house they raised their children in and take the money and move to a smaller home, move to a retirement community, and not have to worry about the tax leakage from all that money that they spent their life building.
Yeah, I love the simplicity of it. Um, $500,000 of gain to be excluded as long as we lived in the house 2 out of the last 5 years. Let's see. You remember when this came in, Mike? I think it was like the late 90s, wasn't it?
It was in the 90s. Yeah, it was
Yeah.
in the 90s. And
Um,
before that, you had to reinvest the proceeds to
it
avoid
was
tax.
complicated
And as
process.
housing prices kept going up, people had big gains and they had to reinvest. So you got the 70-year-old couple selling their house with a $400,000 gain in it that has to go buy a $700,000 house.
It made no sense.
Yeah, that's
It
ridiculous.
was a great improvement in tax law. And like in my home county, well, I mean, there's not very many houses for sale for over a half
Better
million
half
dollars. Now,
million.
where you live, that is very
That's
different.
different.
Very
Yes.
different. So, we went a long time without seeing anybody have a taxable gain on the sale of a personal residence. Now we have them now,
I see a few every year.
periodically.
Yeah.
Yeah, I bet you do. I bet you do. And we'll see one or two, but they're not people that live local to us generally.
Yeah.
Um, but it is those provisions were not indexed for inflation. I believe it was 97. I mean, it's 97 or 98. Those provisions were not, the 250 and the 500 was not indexed for inflation. It's been the same thing
That's true.
since
They've been the same
since
value since
97.
97.
Housing prices are not what they were in 97. I wonder what if somebody with Google or something could look at CPI and housing and tell us what they really would
Figure
be
out what
if
it ought
they
to be
had
now.
been indexed. That's a typical thing that happens in tax law we have
Yeah,
some provisions that don't get indexed and it winds up sucking more people into it than what you would normally think. But
that's true. Yeah.
still, there's an awful lot of the country that the 250 and the 500 covers any
It's
sort of
adequate.
is adequate
Yeah.
still. So.
Yeah. So that's kind of the ones I wanted to talk about. What else do we got? What are the deductions have we not touched on here
Well,
that we ought to at least make a nod towards?
there's a bazillion other things we could talk about. I mean, I love depreciation on assets that are not depreciating. That's kind of cool, right? In terms of I've got a rental property somewhere
Just to
that's
say
a
rental houses. Yeah.
piece of real estate that's appreciating in value, but I get this tax fiction where I get to depreciate the improvements in it and that type of thing. That's pretty cool. Um,
It
and
works to make rental real estate what I like to call tax efficient because it's kind of like the triple benefit concept because the value of the property is going up. That's not taxable till you sell it. The tenant is paying the mortgage for you via the rent. So you're building equity using somebody else's money.
right,
And the depreciation deduction, in most cases, will offset the free cash flow coming out of the property that feels like income to you and ends up being tax free.
right, right. The real
That's
estate,
not a bad little deal. Now, the
no, it's
trick is if you own the thing too long, that depreciation that we liked on the front end, you don't like on the back end.
yeah,
there's a
that's right.
there's a happy medium between market appreciation and depreciation reduction in basis where you need to sell it and then move on and reinvest your money somewhere else.
Yeah, and there's some provisions related to 1031 and exchange that may come into play if you're
Yeah,
continuing to reinvest in real estate. But
that's another podcast probably.
that's a
1031 would
that's
be
a
a
totally we probably ought to do one, and we maybe ought to write that down. We need to do one on real estate and real estate tax benefits.
that would
Um,
be a good one.
yeah, and you could probably tie something onto it related to depreciation. Um, that that would be good. That'd be a whole lot of fun. I bet we'd have lots of viewers on that one as well.
Probably.
So
Yeah.
yeah,
So, well, I think we've covered this topic pretty well.
I think we have too. It was fun, Mike. It was a fun one. I'm enjoying doing these. I hope the quality of this production is getting better. I hope I'm getting a little bit better at delivering the message I want to deliver and not wandering around all over the place. But
Yeah. If
anyway,
we
it's
do,
been
we do.
fun.
That's okay. That's why we're
Yeah,
here. So
that's right. This is
that's why it's
this is
Southern
this.
fried.
That's right.
Oh man. Well, it's about 16 degrees outside. We got snow on the ground, and winter is finally here. So
That actually sounds kind of cool. We're supposed to actually get a little snow tomorrow here. So,
well, it's that time of year, man. The Christmas lights are up. They look nice in the snow, right?
yeah, they do. They do. And I like it. I like North Carolina snow. Like to see it. I like to go outside in it. And I like the fact that it's gone pretty quickly too. So,
Same here in Longmont, where we
uh,
get a little snow. It doesn't tend to hang around very long, and then you can go to work just fine and not have to worry about it. So,
yeah.
well, well,
Good stuff.
we'll do this again next week. It's been great. Take care of
All
yourself,
right.
man.
All right. You too. Thanks, Mike.
See you.
Well, thanks for joining us, everybody. This has been an episode of Southern Fried Finance, produced by Michael F. Ferris, CPA LLC. Vic and Mike really thank you for being here and hope you can join us again next time.